In this week's video, we'll examine the charts and the hard data to help us answer the question, what can we learn from bullish trends in numerous asset classes? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500 index. My cursor is showing 2007. This is 2008 here. We'll use this chart to explain some basic concepts, and then we'll apply them to the present day in July of 2016. On this weekly chart, all things being equal, the probabilities from a bullish perspective are more favorable when price is above all of these weekly moving averages and the slopes of all of them are up, and we would also prefer to see the fastest moving average on top and the slowest moving average on the bottom of the MA cluster. As you can see here in 2007, for the most part, we have a bullish bias, and then we switch over to what we call a full bore bearish look, where price is below all of the moving averages. The slopes of all of the moving averages are down, and the fastest moving averages on the bottom. That tells us that the probability of bad things happening is higher here than it was here. If we fast forward to the bottoming process in 2009, this is the S&P 500's bottom in early March of 2009. We're also looking at a weekly chart now. These are the exact same moving averages, and you can see as the market starts to turn, we go from a full bore bearish look to a full bore bullish look, telling us that the probabilities in this region here are more favorable than the probabilities here. If we fast forward to June 24th, 2016, you can see we have somewhat of this whipsaw mess within the context of the trading range. And on June 24th, the weekly chart looked like it might be about to roll over again. We have positive slopes on our moving averages here. They're starting to flatten out, and some of them are starting to roll over, and now price is below most of the moving averages. The last time we had a rollover and flattening out like this was this period here, and bad things happened after that. Also notice we have a higher high here. This is a lower high, and then we came back up into this region, and as of June 24th, it looks like we were rejected at possible resistance. How does the exact same chart look today? The answer is quite a bit better. We had the sharp reversal here, and we've gone from what was an indecisive look to now a full bore bullish look. And maybe more importantly, we've broken out of the long-term trading range. So from a probability perspective, the S&P 500 right now remains in an uptrend. This is a weekly chart of intermediate-term Treasury bonds in isolation. These are weekly moving averages used by the CCM market model. The market model uses multiple inputs. We're looking at IEF as the ticker symbol in the ETF world. And you can see on Friday, July 22nd, we have a full bore bullish look for intermediate term treasuries. This is a strong bullish trend for intermediate term bonds. If we zoom in a little closer on the S&P 500, we can see we also have a bullish weekly trend in the S&P 500 simultaneously with the bullish trend in bonds, which is not particularly unusual. Similar situation here. Now we're looking at long-term treasury bonds, or TLT, in the ETF world. This is Friday, July 22nd. Also a strong-looking trend here for TLT. Now we're looking at VNQ, which is an ETF. It's a basket of real estate investment trusts, or REITs. They're yield-oriented investments, so they somewhat have a hybrid-type personality. They have some stock-like characteristics, and since they pay dividends, they have some bond-like characteristics. Hence, REITs tend to be interest rate sensitive. This is 2015 here. We have a long-term consolidation pattern in REITs. We had a bullish breakout, what appeared to be a failed breakout, and now we've recaptured that, and we have what is currently a strong bullish trend in REITs. Similar situation in gold. This is 2015 here. Weekly chart with the same moving averages, somewhat of a consolidation look here. Resistance was rejected at a similar area to this rejection here. And then recently we had a bullish breakout to the upside. And you can see the slopes of these moving averages, similar to the charts that we've looked at previously. These are also bullish slopes indicative of an improving trend off of this low. It's a smaller version of our weekly chart of TLT. The consolidation period started in late 2014, and we didn't break out of that consolidation until 2016. What can we learn from the fact that TLT was able to exceed what previously had acted as resistance on a weekly chart? Generally, TLT's breakout aligns with the expectations, the market's expectations, that central banks around the globe will continue to keep interest rates low for an extended period of time, which is something that the ECB reiterated in the past 5 trading sessions. There's a concern due to excessive debt levels and deleveraging that we have deflationary concerns. Therefore, if prices for goods and services are dropping and inflation is low, fixed income instruments like bonds are a good place to be. The markets have numerous economic concerns. Earnings have been slowing in recent quarters in the United States, and global growth remains in that tepid category. If I'm interested in bonds, it may be that I'm concerned about valuations in stocks. If I think stocks are overvalued relative to their price versus their earnings, then I might prefer to own something like a TLT. The global debt issues that we talked about last week, think of it this way. If I borrowed at 5% a few years ago, and I used that money to try to invest in the financial markets, over the past few years, a lot of markets have gone sideways. Therefore, it's hard to invest in the financial markets and meet those minimum payments that I need for that debt service. That's a drag on the economy. Obviously, concerns related to Brexit, and the big concern there, longer term, is the fear of contagion, where other countries may decide to also hold a referendum. Bonds have been indecisive for a long period of time, and they were able to break out. Stocks, this is SPY weekly, have also been indecisive for a long period of time. This is also November of 2014. We stayed in this whipsaw mess consolidation, land of confusion range for quite some time, and recently we're able to break out to new highs. As we've discussed in past videos, central bank policy tends to be more effective when economies are still growing, especially the U.S. economy, and the information or the data that we have in hand right now doesn't look like a recession is going to start tomorrow. Therefore, price has reacted to a lot of the positive things from central banks. The stock market knows about all that excessive debt, and it also knows that the lesser of the evils of all the choices is probably for governments to try to inflate away that debt. One of the reasons why they would prefer to inflate rather than see deflation is the debt burden actually grows in a deflationary scenario. Example, if Social Security tells me they're going to pay me $30,000 a year in 10 years when I retire, hypothetically, and we have a deflationary scenario where prices are falling, if they pay me $30,000 10 years from today, that $30,000 in a deflationary environment will be worth more than it is today in terms of purchasing power. Example, if I can buy a Honda Accord today for $30,000 and we go through a deflationary cycle, I might be able to buy 2 Honda Accords, theoretically, in the future with that same $30,000. While earnings forecasts typically are not worth the paper that they're printed on, forecast for the remainder of the year is for earnings improvement, and that may or may not happen. If it does happen, then we would be able to make the argument that the S&P 500 rallied in expectation that future earnings would be better. The uncertainty relative to Brexit leads to the easy central bank policy, and very, very similar situation, an indecisive and confusing situation in gold. This is November of 2014. Price here was unable to exceed that level, so we also have somewhat of a bottoming look in precious metals. Consolidation. GLD also was able to break out to a new high in 2016. Since debt is a problem all around the world, most countries want to try to inflate it away, and everybody wants a weak currency, and hence we have what's known as a race to the bottom or currency wars, which leads to currency debasement and possibly future inflation. Obviously, with all the problems related to Brexit and the debt levels that we talked about last week, there are concerns about longer-term systemic risk. Easy central bank policy has not only inflated PEs in the stock market, but you can make an argument that bond valuations are extremely vulnerable as well, and something like gold that has been in a longer-term downtrend over the past few years may look more attractive to investors. Longer-term history tells us in terms of long-term economic and debt cycles that when we get to one of these deleveraging periods where there's too much debt in the system, the script is typically to debase currencies and try to inflate that away, hence the desire to own a physical store of value or a physical currency in the form of gold. Last week we talked about helicopter money. We may be hearing more about helicopter money over the next few years. The market is concerned about future inflation. Ultimately, a GLD can help you protect your purchasing power relative to storing it in a paper currency that can be debased. It's been a difficult period with stocks, bonds, and gold all stuck in boxes dating back to 2014. However, we know that difficult markets are typically followed by easier markets. And as we can see here, indecisiveness in bonds, indecisiveness in the stock market, indecisiveness in the precious metals market. All three markets have broken out of the boxes at the same time. The breakouts tell us that it's quite possible that the period of confusion in all three of these asset classes has ended. Only price can determine that, but as long as we stay above the top of these boxes and the math and data tell us that we have a bullish trend in bonds, a bullish trend in stocks, and a bullish trend in precious metals, the default is to hold our assets now that the period of indecision has ended. In terms of managing existing positions in these three asset classes, the math, the boxes, and the hard data can help us, obviously, but also incremental or marginal changes in market expectations relative to these bullet points will determine whether or not all three of these bullish trends remain in place, only one of the three, or two of the three. We don't need to know that in advance. We just keep our eye on the hard data and keep our eye on the fundamentals as well. The Dow has also been in a long-term consolidation box. We have the bullish breakout. It's possible we might want to see a retest here. The market will make that call. Some bullish and positive signs on the Wilshire 5000 index, which is a broad index. Resistance, resistance, resistance here. We've cleared all of those levels, and this candle here is fairly good looking after this breakout here. These two candles tell us that the odds of the breakout holding at least above these levels right now appears to be a little bit more favorable than the type of candles that we saw in here, and in here. The Wilshire 5000 has done some nice things relative to this area of possible resistance. However, we're still hovering around the highs from 2015, and as long as we stay near them, this still could act as potential resistance in the short run. Obviously, for the stock market bulls, they'd like to see price get into this area here and hold that area. Revisiting our long-term and possible inflection point looks, it's good to keep in mind in 2011, we came back and we retested the break above the 61.8% retracement. If the same thing were to happen in the present day, that would mean that the market would come back to this blue line here. That may or may not happen. It's just something that we need to know about. It wouldn't be that surprising if the market backtracked a little bit. On the bullish end of the spectrum, given how tight this consolidation range is, it also wouldn't be surprising if the market just decided to skip the retest. Given the fact that we've demonstrated that bonds are still in a bullish uptrend and we have charts like this, there's no need necessarily at this point to run away from fixed income. This is the broad NYSE versus long-term treasury bonds, or TLT. This is a weekly chart here. This is the peak in 2015. And you can see it really hasn't broken out yet in a meaningful way. That may happen, but it hasn't happened yet. We'll learn something either way. In this area here, stocks and equities start to become a little bit more attractive relative to bonds. We're not using a chart like this to try to paint necessarily a bearish picture for the stock market. A chart like this is used to help us with our allocations between bonds and stocks, both of which remain in bullish uptrends. NYSE weekly, these are the areas of possible resistance that we've been watching. This is the second weekly close above these levels. Just a few weeks ago, the 61.8% retracement was still acting as resistance, but you can see now we've moved away from it. The longer we're above it, the better it is for the bullish case, and that's one of the reasons why during this move here, the market model has started to add to our growth-oriented positions. You can make an argument here that this weekly NYSE chart could be forming or breaking out from what's known as an inverse head and shoulders pattern. This would be my left shoulder, my head, and my right shoulder. This is the neckline. Here, if you've ever done any forecasting with these type of patterns, it's telling us the longer that we stay above the neckline, the higher the probability that we could get an impressive run above the neckline. Obviously, the market will make that decision, and all patterns do as they help us with probabilities. The NASDAQ, kind of a mixed bag here. This is the peak in 2015 on the daily chart. Resistance here later in 2015. This week we were able to close above it on the daily chart here, telling us it's possible. There's white space above now if we can hold this breakout, and it may be relatively easy for the NASDAQ to run toward the top of the orange box. As we've discussed in the past, here's the gap at the beginning of the year. The NASDAQ failed at the gap. Now we've succeeded at the gap, and we're still holding above the gap. This looks quite a bit better than this or this. With concerns related to Brexit still with us, this is the German DAX. It's been unable to break out yet. This is a downward sloping trend line. On a closing basis, the last time the DAX made a new closing high was back in April of this year. This is the glass half empty perspective, the glass half full perspective. This is a low. This is a lower low on the weekly chart, and this is a lower low on the weekly chart. It's possible that we're trying to print a higher low now on the weekly chart. If a bullish trend is going to start, at some point you have to make a higher low. Still have potential resistance in the form of this red trend line. Global stocks also have some work to do relative to bonds. Checking in on the VIX chart that we've been looking at, support for the VIX here, support for the VIX here. Bad things happen in the S&P 500. Here, support, support. Now it appears that we have broken this upward sloping blue trend line. All things being equal, this breakout aligns with the bullish breakout in the equity markets. IWM weekly, somewhat of a mixed bag. The last three candles here look good. However, this is potential resistance here, so we still have a hurdle to clear in the form of this blue line. Transportation stocks daily still have some work to do. We'll learn something either way. It's a weekly chart of GLD relative to SPY. Got a downward sloping trend line here and a bullish breakout. GLD has yet to make a higher high above this level here relative to SPY, but we've already shown that both GLD and SPY are in bullish trends. Thus, this sideways look here isn't particularly concerning as long as the math supports both of them in isolation. RSI doing some nice things here in favor of gold. Here's a low in RSI. Price is still falling, and RSI is making higher lows. That's potentially a bullish divergence in favor of gold relative to stocks. Also, we have somewhat of a left shoulder ahead and a right shoulder forming here. You can also have an improving look. Price is in this general area here where my cursor is. Below it, RSI stays in the orange box and for the most part stays below 50. When price is back up in the same general area now, RSI is quite a bit higher and the bias seems to be to stay above 50 rather than below 50. We've shown that both SPY and GLD have good-looking trends in isolation. Silver looks better than gold, at least in the short run here. You can make an argument here. This is an inverse head and shoulders, possibly consolidation pattern, left shoulder, head, right shoulder. The ratio of silver to gold has broken out above the neckline. And we also have somewhat of a favorable look from RSI. Level here, this is my left shoulder. RSI is down in the orange box. When I'm in the same area here in terms of the ratio and price, RSI is a lot higher in the green box. Since silver has a lot more industrial uses than gold, all things being equal, silver breaking out here or trying to break out relative to gold tends to be favorable for the economy, which in turn could be favorable for the stock market and future earnings. Of course, that's to be determined. This is the weekly chart of REITs that we covered a few weeks ago. This is as of July 22nd. Resistance, resistance, bullish breakout, and thus far a nice run after the breakout on the weekly chart. REITs pay dividends, and thus they tend to be interest rate sensitive like bonds. This is 2014. This longer term breakout here on the weekly chart also aligns with the breakout or message that we get from TLT. And that is, if this is rallying, it's telling us that the market expects the Fed to keep interest rates low for an extended period of time. Interest rate sensitive REITs have been able to break out, while economically sensitive materials, XLB, have yet to clear this downward sloping trend line. That may happen, but it hasn't happened yet, and we'll learn something either way. Here's the S&P 500's bullish breakout here. Here's the ratio of the S&P 500 relative to gold, the exact same time frame. So this is August of 2014, and this is August of 2014. The S&P 500 in isolation is making new highs on this chart, but the ratio of the S&P 500 relative to gold hasn't made a new high since May of this year. We'll learn something either way, and charts like this help us manage allocations between gold and the S&P 500. We don't necessarily use this to try to build the case that's bearish for the S&P 500. Similar situation here, large cap dividend stocks. So they are also interest rate sensitive like REITs, August of 2014, August of 2014. The S&P 500 looks like it's been shot out of a cannon off of this Brexit low. This move in the ratio has been much tamer. And while the S&P 500 has rallied off of this low, the ratio of the S&P 500 to SDY has actually fallen. Same exact concepts. Now we're looking at the S&P 500 relative to TLT. S&P 500 making a new high, while the ratio hasn't made a new high since April of this year. S&P 500 has exceeded the highs from 2015. If we look at the ratio of the S&P 500 relative to interest rate sensitive and dividend paying REITs, this is the level that the S&P 500 cleared from the spring of 2015. That would be this level here on this ratio. Thus, for now, this ratio favors REITs over the S&P 500, and we know that the S&P 500 has good numbers and a bullish trend. We still have some charts that are concerning relative to the economy. As the S&P 500 has rallied off of this Brexit low here, and as it's rallied here, if we look at the ratio of economically sensitive materials, XLB, relative to more conservative or defensive-oriented bonds, TLT, like many of the other charts, this ratio has not made a higher high since April of this year. Also, like the other charts, we'll learn something either way if this ratio wants to fill the white space or if it wants to break out above the orange line. Similar situation, energy XLE relative to TLT. The last time it made a new high was either in late April or early May of this year. That may change, but it hasn't changed yet. SPY versus IEF is kind of a mixed bag. The good news for SPY relative to IEF, it was able to clear these levels here. However, this downward sloping trend line here, if we take that angle and look for a trend channel and attach it to these highs here, this ratio still has some work to do. As we've shown in this video, the math and the trends look good for both SPY and IEF. Charts like this are used for an opportunity cost analysis along these lines. If SPY and IEF are both bullish and strong, how much should I allocate to each one? We know that easier markets can be followed by harder markets, or periods of indecisiveness and low conviction can be followed by periods with strong conviction and strong trends, even under a bullish scenario. This is the S&P 500 here in 1994. This is 1993 here. This is a sideways consolidation period, very frustrating, difficult to deal with. We get the bullish breakout here. Everything looks wonderful. But in this case, we did have a retest. We came back and retested this area here that had previously acted as resistant. That's not a forecast. It just helps us realize that in 2016, even if the bullish trends continue and the breakouts hold, we may see a retest. A passing grade on a retest means that you come back and test the breakout level and then start to move higher again. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.